Hello, savvy investors. Today, we're diving into a topic that's crucial for maximizing your investment returns: tax-efficient investing. Look, we all know that taxes are a part of life, but that doesn't mean we have to like them, right? Especially when it comes to our hard-earned investment profits. The truth is, understanding how taxes impact your investments can make a huge difference in the long run. It's not just about how much you make, but also about how much you get to keep after the IRS takes their cut. In this video, I'm going to break down some powerful strategies to help you keep more of your money working for you. Let's get started. One of the smartest moves you can make as an investor is to take full advantage of tax-advantaged accounts like Roth IRAs and 401ks. These accounts offer incredible tax benefits that can supercharge your investment growth over time. Let's break it down. First up, we have the Roth IRA. Now, what makes the Roth IRA so special? It all comes down to the beauty of tax-free withdrawals in retirement. You contribute after-tax dollars to a Roth IRA, meaning you pay taxes up front. But here's the kicker. When you retire and start taking distributions, you won't owe a single dime in taxes on those withdrawals. That's right, tax-free income to enjoy your golden years. Next, we have the 401k, which is a retirement savings plan offered by many employers. With a 401k, you're contributing pre-tax dollars, which means you get to reduce your taxable income for the year. This can lead to some sweet tax savings in the present. Plus, your money grows tax-deferred, meaning you won't pay taxes on any investment earnings until you withdraw the funds in retirement. Now, here's another pro tip. If your employer offers a 401k match, contribute at least enough to get the full match. It's like getting free money, people. Don't leave that on the table. But remember, like with all good things in life, there are contribution limits to these accounts. For 2023, you can contribute up to $6,500 to a Roth IRA and $22,500 to a 401k. And if you're 50 or older, you get to make even larger catch-up contributions. The key takeaway here is that tax-advantaged accounts are your best friends when it comes to building long-term wealth. So make sure you're taking advantage of these powerful tools to minimize your tax burden and maximize your investment returns. We all know that diversification is key in investing, but did you know that it's also crucial for minimizing your tax liability? That's right, diversifying your account types can help you strategically manage your taxes and keep more money in your pocket. Think of it this way: having a mix of taxable and tax-advantaged accounts is like having different buckets for your investments, each with its own set of tax rules. This gives you more flexibility and control over when and how you pay taxes on your investment income. For example, you might hold investments that generate more taxable income, like bonds or REITs, in a tax-advantaged account like a Roth IRA. This way, you can potentially shield that income from taxes altogether. On the other hand, you might choose to hold growth-oriented investments like stocks in a taxable account. Why? Because long-term capital gains, which are the profits you make from selling assets you've held for over a year, are taxed at a lower rate than ordinary income. By strategically allocating your investments across different account types, you can potentially minimize your overall tax burden and keep more of your hard-earned money working for you. It's all about finding the right balance for your individual financial situation and goals. Now that we've talked about the importance of tax-advantaged accounts and diversifying your account types, let's dive into another crucial aspect of tax-efficient investing: choosing tax-efficient investments. When it comes to taxes, not all investments are created equal. Some investments, like actively managed mutual funds, tend to generate more taxable events than others. This is because they frequently buy and sell securities, which can trigger capital gains distributions. On the other hand, investments like ETFs and index funds are generally more tax efficient. This is because they tend to have lower turnover rates, meaning they buy and hold securities for longer periods. This can result in fewer taxable events and potentially lower your tax bill. Another tax-efficient investment option to consider is municipal bonds. Municipal bonds are issued by state and local governments, and the interest income they generate is often exempt from federal income taxes, and sometimes even state and local taxes. Of course, the best investments for you will depend on your individual financial circumstances, risk tolerance, and investment goals. But by understanding the tax implications of different investment options, you can make more informed decisions. and potentially keep more of your investment returns. So, you've got your tax-advantaged accounts, you're diversifying your account types, and you're choosing tax-efficient investments. Now what? Well, the next step is to make sure you're matching your investments with the right account type. Think of it this way. You want to put your most tax-inefficient investments in your tax-advantaged accounts, where they can potentially grow tax-deferred or even tax-free. This way, you can maximize the benefits of these accounts and minimize your tax liability. For example, you might choose to hold investments that generate a lot of dividends, such as REITs or high dividend-paying stocks, in a Roth IRA. This way, you can potentially avoid paying taxes on those dividends altogether. On the other hand, you might choose to hold investments that are more tax-efficient, such as ETFs or index funds, in a taxable account. This is because long-term capital gains, which are the profits you make from selling assets you've held for over a year, are taxed at a lower rate than ordinary income. Remember, it's all about finding the right balance for your individual financial situation and goals. By strategically allocating your investments across different account types, you can potentially minimize your overall tax burden and keep more of your hard-earned money working for you. Let's talk about one of the simplest yet most effective tax-efficient investing strategies: holding your investments for the long haul. Yes, patience really is a virtue when it comes to investing, especially when taxes are involved. Here's why. The longer you hold an investment, the more favorable the tax treatment of your profits. Short-term capital gains, which are profits from selling assets you've held for a year or less, are taxed as ordinary income. And as we all know, ordinary income tax rates can be pretty steep. But here's the good news. Long-term capital gains, which are profits from selling assets you've held for over a year, are taxed at a much lower rate. In fact, depending on your income level, you might even qualify for a 0% long-term capital gains rate. So what does this mean for you? It means that by simply holding on to your investments for longer than a year, you can potentially save a significant amount of money in taxes. Plus, it encourages you to be a more disciplined and long-term investor, which can lead to better investment outcomes over time. Of course, there will be times when it makes sense to sell an investment before the one-year mark, such as if your investment thesis has changed, or if you need to rebalance your portfolio. But in general, aiming to hold your investments for the long term can be a powerful way to reduce your tax liability and keep more of your investment profits. Let's be real, nobody likes to experience losses in the stock market. But what if I told you that you could actually use those losses to your advantage come tax time? That's the power of tax loss harvesting. Tax loss harvesting is a strategy that involves selling losing investments to offset capital gains realized from selling winning investments. It's like strategically taking a loss on paper to reduce your overall tax liability. Here's how it works. Let's say you sold some stocks earlier this year and made a nice profit of $10,000. Congratulations! But hold on. Before you celebrate too much, remember that you'll likely owe taxes on those capital gains. Now, let's say you also have some other investments that have lost value. Let's say $5,000. By selling those losing investments, you can realize a capital loss that can be used to offset your capital gains. In this case, you could potentially reduce your taxable capital gains from $10,000 to $5,000. But it gets even better. If your capital losses exceed your capital gains for the year, you can use up to $3,000 of those excess losses to offset your ordinary income. And any remaining losses can be carried forward to future tax years to offset future gains. Tax loss harvesting is a powerful tool that can help you minimize your tax liability and keep more of your hard-earned money. However, it's important to note that you should never let tax considerations drive your investment decisions. Always make sure you're comfortable with the investment thesis of any security you're buying or selling, regardless of its tax implications. So there you have it, savvy investors. We've covered a lot of ground today, from the power of tax-advantaged accounts to the benefits of tax loss harvesting. Remember, tax-efficient investing isn't about avoiding taxes altogether. It's about being smart and strategic to minimize your tax liability and keep more of your hard-earned money working for you. As always, it's crucial to consult with a qualified tax advisor to develop a personalized plan that aligns with your specific financial situation and goals. Thanks for watching, and here's to maximizing your investment returns.